So,
That's my
in
favorite
terms
thing.
of the gamification, maybe we could dive into that.
Yeah. So, as far as the users, like the thing that's allowed us to have very competitive rates over the last year, even without our own token, has been the fact that our reserve factor, the amount that we take from the interest that's generated on the platform, is lower than anyone else. Like anyone else. There's no questioning that. There's no like competition there. Our reserve factor on Phantom and Optimism are actually currently like 1%, whereas a lot of competitors are anywhere from like 25 to 50%. Um, it's a huge difference, and so we are, 20 times as cheap as some of these, and that's going to change as we go into our own token. But the point is that the reason that it's changing, the reason that that is changing, is because the net benefit of the token is going back to the users. And in my opinion, and I think in Beavis's opinion as well, I don't think I've ever actually put him on the spot though, is that I don't see that a platform is successful unless the primary beneficiary of like the platform's like reason for being is the user. Like if the users don't benefit more than the devs, it's a fucking scam. Like at least in my opinion, I think that in
I
any
agree.
system, yeah, in any system where you have things set up to where you have like a massive pre-mint, you're holding like 30% of the supply of your token, or you're you're taking fees on absolutely every single thing, or you're building in what like you don't I don't need to go down the list of shitty things that platforms have done. Um, I would say that we have designed the token in such a way, and this isn't going to be live day one because, as I mentioned before, we build things out slowly, one step at a time. But everything that the token, like every aspect of the token, is all for the token holders. It's not for the team. It's not for some VC because we don't have any VCs. We don't have any outside funding whatsoever. Really, we have
You
some
want to go into
incentives.
the tokenomics a little bit more since we're
Yeah,
talking about it?
sure. Actually, Beavis can probably take over from this point and do that.
Yeah, yeah. So one of the biggest problems with tokens is usually, so there are three parties. There's the user, there's the liquidity provider, and there's the governor or the token holder. And usually, what we see in protocols is it's the governor basically footing the bill for market penetration, which in a lot of times is many millions of dollars. And the people that benefit are the users and the LPs. And there's an assumption, a really bad assumption in crypto, that token holders are going to be users or they're going to be liquidity providers. And most of the time, that's not the case. Usually, people that operate at the governance level or the holder level don't participate a lot in DeFi. And the people that participate in DeFi are looking for low risk yield opportunities. And they're not participating at the like trading token type level. So there's a massive, massive, massive disconnect there. And kind of our approach to tokenomics is one that, um, you know, we have two main things we think about. We think about compliance. How can we ensure that this is safe and that every user participating is participating in the best way possible? And sustainability. How can we actually create positive sum finance? And how we've done that with Granary, and this is a little complicated. I mean, it's really simple, but it's maybe a little complicated. But basically, Granary generates more funds or more revenue because it's able to lend to other protocols in addition to users. So that's a system we refer to right now as Granary V2. That will be audited right after the LGE is finished. All the code is done. So basically, we can ensure to a certain extent that Granary is making or generating more revenue than any other lending platform on the network because we have a much bigger addressable market, being other protocols. So think of us kind of like a gravity well. We're going to be sucking in yield from all around the network. And then how do we get that yield to users? in a way that doesn't leave the governors high and dry, because the way to have safe and effective governance is to have a lot of volume, wide distribution. And to do that, you need a lot of activity. You need a good velocity of money, which is how often tokens move around, change hands, how often are people actually deeply engaged with the protocol. So what we do is we take this revenue, which if you read some of our documentation, we have a good thread, if you don't mind posting that, Flu, that has a lot of information about granary. But we take that revenue, which in some instances may be an order of magnitude higher than other offerings on the network, and we use that, we buy the grain token. And where do we buy the grain token from? So we buy the grain token from a pool that is specifically designed for governors. So in teaming up with Balancer and Beethoven X, we've designed a system that uses 80-20 liquidity pools. So users aren't overexposed to impermanent loss because the pool is 80% grain, but they're also taking on some level of protocol risk. And what we do is we route all of that revenue through that pool to buy back grain. And that pool is a relatively high fee pool. So you may see a fee of 1% to 2% being used to incentivize those governors for settling the trade. And then what we do is we take that grain and we redistribute it. And we redistribute it based on revenue generated by the pool. So if you take which pool, borrow side or supply side, generated the most revenue for us or generated the most opportunity for us, and that tells us exactly how to divvy up those rewards. And we emit rewards based on that so we can continue incentivizing the highest revenue pools. And then users borrow, users deposit, users interact with the protocol, generate more revenue for the protocol. We take that revenue, we continue to buy back grain. And now what you have is a closed disconnect. So instead of users or governors and holders just spitting out incentives and not knowing what's going to happen the next week or the next time an LP decides they don't care to hold the token anymore, we have governors constantly receiving these fees. We have them, the protocol is essentially creating all this velocity in the grain token. And now LPs and borrowers might think twice before they sell. And so even in a world where every single person sold their grain onto the market, the governors still win. And the reason for that is because we're buying, the protocol is buying the grain back. The governors are getting a fee for settling that trade. Okay, so let's say that fee is 2% or 1%. They get 1% there. Awesome. And then let's say the LPs, this is a worst case scenario. All the LPs are jerks. Flu and I aren't LPing. We're like asleep. There are no holders LPing. Those people dump all their tokens. Okay, another 1% fee. What happens? Because, it's an AMM invariant, it goes up an amount, down an amount. And in this worst case scenario, the end user still gets, or the governor still gets a 2% fee or a 4% fee, depending on how that's configured. And the real beauty of this system is over time, as revenue grows, it becomes self-sustaining. So any grain that is inflationary is spent almost explicitly to penetrate markets. It's not needed to actually sustain liquidity, because once you penetrate a market to the point of diminishing return, the system funds its own incentives and it funds itself. And we can always ensure, because our addressable market is bigger, remember, we can deposit into other protocols, we can always ensure that we are the most competitive option on any network. And yeah, that's, I guess, like the long and short of it.
Nice.